All right, we've got earnings tonight, but the big picture right now, of course, also includes GDP tomorrow, then inflation on Friday. Let's start the convo with Sonders, Chief Investment Strategist at Schwab's Center for Financial Research. Let's talk some Russell 2000, some small caps first, just because they've really kind of been the most exciting one to watch here. What do you think about the volatility we're still seeing in that group?
Well, that's the part of the market that has continued to be incredibly connected in an inverse way to what's going on with bond yields. You know, the S&P and even the NASDAQ was, to a large degree, from the period late July to late October when you had the big spike up in longer-term yields like the 10-year, and that led to a correction in those indexes. And then when you saw the reversal down back to below 4% in the case of the 10-year, that gave a lift to the S&P and the NASDAQ, and to a significant degree, small caps. But since then, we had that bottom recently under 3.8 in the 10-year, back up to pushing 4.2, and it doesn't seem to be having a disproportionate impact up the cap spectrum in indexes like the S&P. But I think that's one of the reasons why you've continued to see some pressure on small caps and also a related equal weight relative to cap weight.
Okay. Yeah, that's kind of what I've latched onto as well as the explanation, given the stat you've told us a few times about the level of unprofitability in that index, like 30% or something?
It's closer to 40% for non-profitable, but you are about 30% of zombie companies. So companies within the Russell 2000 that don't have sufficient cash flows to pay interest on their debt. So that's another metric that's very high in that index.
That's right. Yikes. All right. Speaking of credit, speaking of interest, let's bring in Cooper Howard, Director of Fixed Income Strategist at Schwab's Center for Financial Research. Right now, we got a little bit of drama in bonds again. What'd you think about that 5-year auction today, Cooper?
You know, I think that we saw a little bit of drama in the bond market. I think that really the story in the bond market is what's going on with Fed policy, though. I think what's more important is kind of looking at, are they going to hike in March or are they going to hike in May? So I think that's really what the market's looking at. We've seen a little bit of a run-up in the 10-year Treasury, especially following today's data reports. I think that pointed probably to a little bit more a narrative towards the soft landing. So I think those are the bigger stories that I'm kind of watching this morning, Oliver, or this afternoon, I should say.
So not too worrisome as, we've still got a lot of these kind of commentators speaking about term premium stuff that's not keeping you up at night, Cooper?
Oh, I love talking about the term premium. So anytime we get a little bond wonkiness, I think that's great news. So it's not really something that's coming up too often. But I think that if you look back to a lot of the moves that we've seen since October, that can be partially attributable to the term premium. So if we get into bond math 101, or I guess not 101, 103 maybe, you can break down the 10-year Treasury into the term premium, inflation expectations, and then Fed funds policy. So I think that given inflation expectations, they continue to still remain below 2% or remain low. They're trending towards 2%, the Fed's target. Fed policy hasn't moved. Expectations, though, however, have moved. And so that's where really what we're seeing into some moves coming from the term premium.
Okay. To see how stocks have responded to this, the Russell takes the dive, as we talked about, Lisanne. Big tech almost kind of acting as a safety trade. A lot of days where we're fading Russell. The NASDAQ actually firms up. It's pretty fascinating to watch. Do the earnings line up with that degree of confidence the market is trading it as?
Well, we haven't really gotten the big rash of big mega cap tech related names. That starts after the close today, and we'll get a decent chunk of the Magnificent Seven. So I think we'll obviously have a bit more color in that area. But even among that group of stocks, you have a really wide divergence that's opened up. If you rank year-to-date performance of the Magnificent Seven, you've got NVIDIA in the number 2 spot, but you have Tesla in the number 500 spot. So, and overall, 3-month realized correlations have come down. So it is turning into a little bit more of a stock picker's market, and the opportunities are not just in the Magnificent Seven. And I think that's a story that's not being loudly told yet.
So far for what we've gotten, are we hitting generally our kind of average for beat rates and stuff, or is even worth talking about yet?
Yeah, beat rate's about 80% right now. That's come down a bit from more like the high 80s. That even at the 80 though, it's still a little bit better than expected. I guess the only rubs are that the percent by which companies have beaten so far is about 3.5%. That is below average. The revenue beat rate is below average. The percent by which companies have beaten on revenues is below average. Net profit margins have come down relative to the boost they got in the third quarter, and every quarter in calendar year 2024 has been revised down pretty significantly for the first 2 quarters. So under the surface, it's a little less rosy than just an above average beat rate would suggest.
Got it. All right. Yeah, not exactly perfect picture underneath the top line numbers. To stay on the news flow from today, our PMI and the manufacturing hit above 50, ahead of GDP tomorrow. Cooper, what's kind of our framework for that number tomorrow? What should we be thinking about?
I think that we're probably going to look at a strong number. I wouldn't necessarily a strong number, but we have seen some revisions being moved a little bit higher. We saw the retail sales numbers come in stronger than expected, so that does bode well for GDP tomorrow. So I wouldn't be too surprised if we see a little bit stronger than what we saw last quarter.
Okay. And PCE, Lizanne, I'll give you the last word for Friday. What can we tolerate at this point?
The PCE doesn't tend to be a big outlier because you essentially get the information that goes into PCE from the combination of CPI and PPI. So I don't expect it to be a significant outlier. But anything that moves the needle toward the hotter inflation front, especially as we start to see some feeders from the problems in shipping, all else equal, that changes maybe the perspective on Fed policy. But I don't anticipate that to be a big needle mover when it comes out.
Okay. Great stuff. Thanks, team. Glad we got you both. Appreciate it, Liz Ann Sonders, Cooper Howard, Schwab's Center for Financial Research.